Okay, today we're going to do the section 4, last topic, which is the valuation of inventory. This is the area that we're going to go through, understand the basic of the valuation of inventory at the lower of cost and net realizable value, and then prepare the simple valuation statement and recognize the impact on the error made on the inventory. Valuation of inventory. Inventory is a goods held for resale by a business at any time. Means that you intend to buy it, to sell it, not for keep it. That is called inventory. Inventory is always valued at the lower of cost and net realizable value. What is meant by the cost? What is meant by the net realizable value? Cost is the actual purchase price plus any additional cost incurred in bringing the inventory to the premise with present condition. That means go to your warehouse. For example, if you buy a shoe, you buy the shoe to sell. Your business is buy and sell the shoe. When you buy one pair, cost you $10, and you buy a lot. You ask supplier send goods to you. Supplier say, okay, they will charge you the carriage cost. So this carriage cost we call carriage, the transport cost, carriage inward. That in order to bring your goods to the warehouse, okay, they charge you $1 for each pair they send. So total cost will become $11. That is about so-called additional cost. Purchase price, this is your purchase price, $10, and this is your additional cost, which is $11 for the cost. If you buy from the overseas, maybe you have to incur the additional cost. Like example, you need to pay the duty, the import duty. There is one of the examples. Sometimes you need to pay the taxes. So depending on the country. Net realizable value, the estimate receipt from the sales of inventory, less any cost of completing or selling the goods. For example, you intend to sell your this at $20. That is the estimate receipt of the sales. But somehow, when you keep into the warehouse too long, then in order to sell at $20, maybe you need to incur another $5. So now your net realizable value become $15. So this is your net realizable value. And lower of cost and net realizable value, you need to compare which one is lower. Then you use the price to record in your closing inventory. So let's say your closing inventory, you have 100 units. So this is lower. So you times $11. So become 1,100. This is your closing inventory value that you should record. Okay. Next, continue. What are the accounting principles that apply in this topic? As I say many times, the topic that usually is related is prudence. Okay, prudence because it's talking about the profit should not be overstated, and the asset also not supposed to be overstated. So when we inventory is valued at the lower of cost and net realizable value, then our profit will not be overstated, asset also won't be overstated. Consistency, the method of valuing the inventory should be consistent, because you're going to learn the first in, first out method, weighted average method. So these two methods, once you choose it by right, you should continue use it for many years. Realization, the inventory is recognized when legal liability to pay is incurred by the business. which is the ownership of the goods has transferred to the business. That is called realization concept. Means when you should recognize this is your stock. When you receive the goods in the condition that you want, then the supplier pass the goods to you. That become your own one. You own it. That's called, sorry for that. Now next up, valuation of inventory. Two methods. First in, first out. First in, first out means that you buy today. Today is 26 March. So you bought 1,000 unit. And tomorrow, 27, you buy another 100 unit. For first in, first out means that when you want to issue out, when you want to sell, you assuming you are taking these goods out first. That is called first in, first out method. Weighted average cost, which is that inventory calculated after every delivery to the business. Closing inventory at any given time and inventory sold or issued is valued at the weighted average cost. Differences is that here when we let's say we issue 150. So the balance of the stock on this date will be 1,000 minus this become 850 plus another 100. So this is total goods that we have. So when we calculated the price, we will base on this unit that we have. Let's say we buy on this date, we got, because we buy more, we get $9. Whereas this one we buy less, they charge us $10. In this case, this one times 9, this one will times 10. So this is our closing inventory. But weighted average is each time when you in or out, you have to, when you buy the new price, when you buy, each time you buy, then you have to recalculate your price of the cost of the inventory, closing inventory. When you issue out or you sold, you will base on this to charge out to the account. Okay, let's continue. Okay. This is an example that to share with you. First in, first out method. For example, on the first, we received the goods 20 and at the cost of 150. So total is closing inventory is 3,000. Assuming that in between no sales, no anything, on 7, we receive another batch. And this batch now will be the 50. Okay, we will have the 50 unit of it. This 50 unit of it, we have to type individual to get the total closing inventory. In the following day, on 8, we sell the goods. We send out the goods. So the goods total is 40 units. So we will take from here 20 units, another 20 units from here. So the price of the cost of sales, this is actually a cost of sales, will be different due to the different price that we purchase. Okay. End of the month, if you want to calculate the closing inventory, we left with the quantity 10 units and at the price 200, because this one already issue out. So we first in, first out means that whatever you buy, you issue out first. So this one you issue out already. So left with the another 10, which is from the new unit that you bought, which is in here that you bought. Okay, following day you purchase again. So this goods will be taken into here, will be taken in, and this is from the old stock. So total price. Continue when the following day, 20th, we issue out. So same thing, you take out the old stock first, the latest one you will issue later. So end of the month, the balance of the stock will be calculated according to the last item, still new unit keeping in the warehouse and calculate the purchase price. So this is how the closing inventory being calculated. But so far in the exam, the question didn't really ask us to do this inventory cut. Okay, we continue with the weighted average method. Under the weighted average method, each time of the purchase, Means that when you have a purchase, this is a purchase, the new purchase, you have to recalculate the unit price of the closing inventory because you need to use it to issue out. How to calculate? Take the total of the last transaction plus the total cost. So you get this one, 250 plus 180, which is 430. So take 430 divided by 250, then you will get the unit price for the closing inventory. And whenever you have the goods issue out, you will use the same rate for the issuing. And the balance, just take the quantity times the unit price, then you get the amount. When you have a new purchase on 20th, you will take the total value. You take your previous month, 189.2, plus the 30, so you get 219.2. After that, you divide by the quantity that you have, then you get the unit price, the new unit price. And whenever you have a new issue, then you will use the new unit price to issue out. New purchase, you change the unit price again. Whenever issue out, use the new latest price for calculation. So that is how is the weighted average being calculated. But so far in the exam, there is no question really asks you to prepare this inventory method, first in, first out, in the detail form. Okay. The effect of opening, closing inventory. When we have overvalued opening inventory, cost of sales will be overstated. Gross profit or profit for the year will be understated. These normally have the same direction, understate, understate. Undervalue of the opening inventory will be opposite, which is cost of sales, understate. Gross profit, profit for the year, current asset, net asset or equity will be overstated. Whereas closing inventory, when we overvalue closing inventory, cost of sales will be understate. Gross profit, profit for the year, current asset, net asset, equity will be overstate because they're normally in the same direction. When we understate the closing inventory, then here will be overstate, understate, understate. Okay, next is that in future, you're going to learn the manufacturing account. This is something extra for the inventory for manufacturing organization. They have three types of the inventory: raw material, work in progress, and finished good. Raw material is the cost that the goods that you purchase intend to produce another product out. Work in progress is the process of the raw material to the finished good, but yet to be finished. Finished good is a complete goods that ready to sell. That is called finished good. Okay, so this one we were going to learn in detail in manufacturing organization. Okay, so you consider and section 4. If you're going to ready yourself, then you are going to the section 5. Section 5 basically is the different business organization that you're going to learn for it. Okay, that's all for today.